How can Tom Cruise help us better understand risk and return in today's market? Today, I'm going to be talking about the famous movie Jerry Maguire, where Tom Cruise yells, "Show me the money," and how that's relevant for investors today, understanding the term equity risk premium and why that's so important with where bond interest rates are relative to stock prices. So let's get started. To recap, Tom Cruise is an agent for Cuba Gooding Jr. He's a sports agent, and Cuba Gooding Jr. wants a great deal. He wants a great contract, and Tom Cruise is not bringing him the numbers that he wants. And Cuba Gooding Jr. basically gets Tom Cruise to start yelling, "Show me the money," which essentially means for Cuba Gooding Jr., show me the money that I'm going to get for playing on this team. Show me the compensation I'm going to receive. Great. A lot of people have seen that movie. What does that have to do with the stock market and the bond market? Show me the money is what all investors should be saying to their financial advisors, or if they manage their own money, to themselves, in a way that means, if I'm going to be taking the risk of the stock market, how much am I going to be paid for taking the risk of the stock market? So equity risk premium is just another way of an investor saying, show me the money. Because today, right now, I can go and invest in risk-free assets, in treasury bills, right? Risk-free assets means the government is very likely to pay you back with short-term money because they can just print more of it. Okay, so when we're talking about risk-free money, we're typically talking about short-term treasury bills. Okay, right now, and this is late 2023, those are paying about 5% as a round number. We say, okay, that's our risk-free rate. Equity risk premium means the rate of return in excess of or above the risk-free rate you should expect for investing in stocks. So let me give you an example. If you looked at the numbers in the market and the expected rate of return in the stock market, well, let's call it 5% using round numbers, and you can get 5% in your risk-free treasury bill, your equity risk premium is zero. In other words, no one is showing you the money. No one is compensating you to take the additional risk and to deal with the volatility of the stock market. Okay, if your expected rate of return in the stock market was 10%, okay, and the risk-free rate is 5, which is what it is today, okay, your equity risk premium is 5%, which is pretty good. And so we're going to talk about the stock market and the bond market and where the equity risk premium is, and you can decide for yourself, right? Am I seeing the money? Am I seeing what I need to see? And so we've talked about the risk-free rate, which is around 5%. What is a way to calculate the equity risk premium? Well, we have to come up with what is the expected rate of return in the stock market? Well, if you look at a lot of data, the expected rate of return in the stock market based on its current price is not great. What we're going to use today is we're going to use the earnings yield, which is, and we've talked about this in prior videos. So the earnings yield means based on the price I'm paying for a company, right? What is the projected future rate of return based on earnings of that company? And let me tell you the way that we do that calculation. And so if you look at the S&P 500, let's say it's trading, because it is, close to 20, right? If you look at a 20 price to earnings, well, you have the price on the top and you have the earnings on the bottom. What happens when you flip that? And you have the earnings on the top and the price on the bottom. When you have a 20 price to earnings, what that means is you have a 5 earnings yield. Well, as we've talked about, a 5 earnings yield means the expected rate of return in the stock market for the S&P 500 over the next reasonable time period is about 5%. Well, if your risk-free rate is 5, this is a equity risk premium of 0. Now, people can calculate the expected rate of return in the market in different ways, but earnings yield is one way to do it. There's a lot of big banks and investment firms that come out and look at, here's our expected rate of return for the S&P over the next 5 to 10 years. And it's not horribly inconsistent than what you're coming up with earnings yield. Now, this chart here from Morgan Stanley shows the historical equity risk premium. And as you can see over on the right, which is where we are now, it's low. It's very low. Now, what does that mean? It means we're not getting compensated much to take the risk in excess of bonds if we're just looking at the S&P 500. And if you look at this chart, when you have a low equity risk premium, you actually have a high risk. Why is that? Well, because if you look at when the equity risk premium has spiked in the past, what does it mean? How does your equity risk premium spike? Well, the price of stocks goes down. And so what that means is if you look at when all these big spikes are, that's when the price of stocks goes down, because when your price of an asset goes down dramatically, but the earnings stay roughly the same, well, your earnings yield goes up. You can expect a higher rate of return from that asset because now you can pay less for it. And so these spikes in equity risk premium actually represent a downward move in stocks. And as you can see, based on where it is, based on where the equity risk premium is, it's incredibly low. So to spike back to a normal number would mean a drop in the S&P 500 or stock prices. So what does all this mean, right? How are we bringing this together? This is not to say that the stock market's going to fall, right? This is not to make any predictions about the future because it is unknown. That is why we call it the future. But the point here is, with whatever assets you own, you should understand what is the future expected rate of return with that asset, not based on its last 5 years or its last 10 years, based on its current price looking forward. How can you make an educated assumption about that future rate of return? And so all of us as investors should be able to ask our advisor. And if you're managing your own money, that's great. It's essentially like asking yourself, ask your advisor, how are you showing me the money? Or how is my portfolio showing me the money? Do I have a future expected rate of return that is adequate enough for me to take the risk of the stock market? And everybody's personal risk premium is different. For some people, if they're making anything more than the risk-free rate, they feel fine. For others, they might want to make dramatically more than the risk-free rate. But either way, it's important to know this number for yourself so you can make better informed decisions about the future. Thanks for investing your time with the Personal CFO.